Medicare, 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 Medicare. In 1965, Medicare was created as part of the Social Security Act to provide medical insurance to people who were 65 or older, regardless of their medical history. Now, prior to Medicare, only 60% of Americans over age 65 had medical insurance because it was so much more expensive for aging adults. Contrast that to today, where about 65 million individuals are covered by the plan, which ultimately covers about half of all healthcare expenses for those who are enrolled. And the other half is typically covered by private insurance or by simply adding other plans to supplement Plan A and B coverage. Now, because private medical insurance costs are so high, the Medicare eligibility age of 65 sets a sort of artificial milestone for retirees. Many Americans delay their retirement until they reach Medicare age or are very close to it, so they can avoid having to bear all the costs of medical insurance themselves. And they are wise to take this into consideration. Individual medical coverage for an early retiree runs about $5,500 a year, and for family coverage costs about $14,000 each year. And clearly, medical insurance is a considerable factor in any retirement evaluation. If you ignore it, you do so at your own peril. So if you're asking yourself, why is this guy talking about Medicare? That's something only older people have to worry about. That's not true. You really need to plan about how you're going to cover yourself medically as you approach retirement, especially if you retire before age 65. But even 65 and older, there are a lot of strategies around your income, how you realize income that has an impact on the cost of your Medicare coverage. We'll go over all that in this video. So no matter your age, it's worthwhile to know how the program works. All right, let's start with just a basic description of what Medicare covers. There are 4 different plans within Medicare. Each covers a different specific type of care or medical need. The first one's Medicare Part A. Part A is also known as hospital insurance, and as the name suggests, it covers hospital visits, but it also provides coverage for hospice care, skilled nursing facilities, and some home-based care options. Now, Part A coverage is automatic for anyone who receives Social Security benefits, but enrollment is available through the Social Security Administration's website for those who don't already receive benefits. In 2024, the medical deductible and copay amounts are on the screen here. Inpatient hospital deductible is $1,632. I won't read the rest to you. You can kind of look at it yourself. And as you can see, even though Medicare may cover a lot of the costs associated with medical care, it doesn't cover everything. You'll need some cash to cover deductibles and co-payments if you have a medical need, which if you're 65 or older, chances are you will from time to time. The next part of the plan is Medicare Part B. Medicare Part B covers outpatient services like normal doctor visits, preventative services, ambulatory services, mental health care, and some medical devices. Next up is Medicare Part C, which is also known as Medicare Advantage. It's offered by a private insurance company, and it bundles Medicare Parts A and B and usually D as well. Now, at a minimum, Part C providers must provide coverage that is at least equivalent to Medicare Parts A and B. Typically, Advantage plans include Part D, lower out-of-pocket costs, and other benefits like dental, vision, and hearing care that isn't included in Parts A and B. And finally, Medicare Part D helps cover prescription drugs. It's also available as part of Medicare Advantage. So how much does Medicare cost? Well, the cost of various types of Medicare plans depends on a number of factors. For most Americans who have paid Medicare taxes while working, there's no additional cost for Part A aside from the copays and deductibles that we talked about earlier. However, if you worked and paid into Medicare for less than 10 years, you may have to pay a monthly premium for Part A coverage. The standard monthly premium for Part B is $174.70, but your actual premium will depend on your income, which I'll discuss later. Now, your monthly premium for Part B could also be higher if you fail to sign up when you're first eligible for Medicare benefits. For each year that you fail to sign up for Part B after you're eligible, your premium will permanently increase by 10%. Now, the annual deductible for Part B is $240, and after that, the copay is 20% of the cost of whatever services you receive. Pricing for Part C varies depending on the coverage purchased and the out-of-pocket maximums of the plan. Like I already mentioned, it's covered by provided by private insurance. According to the National Council of Aging, the average in 2024 for Part C coverage is $18.50 per month, though premiums can be as high as $200 or more per month. Now, premiums for Medicare Part D also vary depending on which plan you sign up for, and like Part B, you pay a penalty if you fail to sign up when you're first eligible for coverage. In the case of Part B, you'll owe an additional 1% per month for each month that you delay coverage. That's basically 12% per year. And this is a permanent increase in your premium. Okay, so I mentioned earlier that your actual monthly Medicare premiums are dependent upon your income. You may or may not have heard of IRMMA. That's the Income-Related Monthly Adjustment Amount. It's a surcharge that's placed on Medicare premiums for Part B and D based on the beneficiary's modified adjusted gross income. So in other words, the amount of modified adjusted gross income you have will impact your Medicare premiums. Now, one quirky thing to keep in mind about IRMMA is the surcharge is based on your modified adjusted gross income for 2 years prior, not the most recent tax year. So for 2024, your 2022 modified adjusted gross income is used to evaluate whether or not IRMMA applies to you. Now, calculating modified adjusted gross income is a bit tricky. First, you need to know what your adjusted gross income is. That's line 11 on Form 1040. Then you add back other sources of income like untaxed foreign income, non-taxable Social Security benefits, and tax-exempt interest. And now for another IRMMA quirk. Modified adjusted gross income for Medicare is calculated differently than it is for other tax issues like eligibility for Roth IRA contributions. Now, I'm not a licensed tax professional, so I'm obliged to suggest that you reach out to one for help calculating your modified adjusted gross income if you care about it that much. Now, personally, I wouldn't worry too much about it because you don't have to bother calculating your modified adjusted gross income for IRMMA. The Social Security Administration will actually do that for you. And when you sign up for Medicare, you'll be charged the standard premium amounts. And if IRMMA applies to you, you'll receive a predetermination notice, which gives you an opportunity to push back if you feel there was an error in the calculation. And later, you'll receive what's called an initial determination notice with instructions on how to dispute the calculation again if you want to. And if you don't dispute the calculation, your premiums will be withheld from your Social Security benefits. If you don't receive benefits, you'll get a bill with directions for submitting payment. Let's talk a bit more about IRMMA brackets and planning your income so that your Medicare premiums are as affordable as possible. So we got a table on your screen with the 2024 IRMMA brackets and monthly surcharges. You can see the different income ranges. You can see the cost for Part B coverage and for Part D. And it's based, again, upon your modified adjusted gross income. There are many people who intentionally limit withdrawals from retirement accounts or the amount of taxable income they realize just so they can keep their IRMMA premiums low. Now, since this could potentially save you around $5,000 per year per person, it's not necessarily a bad idea. This is especially true if your income is tight in retirement. Now, personally, if you have a comfortable income and significant wealth, I'm not a huge fan of letting the IRMMA tail wag the income dog. And the reason is the annual savings are relatively insignificant if you have a high income or a large amount of wealth. Sure, you could save $5,000 a year by limiting your realized income from $500,000 to $100,000. But if you have the level of wealth or income that would put you in that highest bracket, what would you be saving the money for? And if your income is lower, your surcharge is even less, meaning the payoff for placing restrictions on your income is less significant or impactful. I mean, ultimately, you've got to be 65 or older to enroll in Medicare. You're not necessarily young anymore. It's time to enjoy your wealth, not pinch pennies. Additionally, you could have the opportunity to do some Roth conversions, which have the potential to save you far more over the remainder of your life than your monthly IRMMA premium would. And many times it's penny wise and pound foolish to choose lower IRMMA premiums over conversions, especially if you have a large tax-deferred retirement account balance that will be subject to required minimum distributions one day. You need to be sure to keep all these moving parts in mind as you evaluate your income plans for retirement.